Preparing to live stream. This meeting is being live streamed. Welcome in to all the listeners. This is the Chit Chat Money Investing Power Hour number 19. And we're having some Zoom trouble, but we are up and running now. So about a minute late, but I think hopefully any viewers will forgive us. The structure of this show is that we bring nothing prepared, but riff on all things financial markets, and it's busy season. Probably, I would say week 3 of earnings season really kicking off. Financials don't really count. That's like a lost week. It's kind of the tone setter, but it's like, all right, get your ducks in a row. The real earnings season is about to start. And then, but yeah, we're week 3. That's comprised most of my time. How about you? Anything worth talking about this week? Anything newsworthy?
Yeah, I mean, I looked at some earnings reports for sure. Stuff we own, stuff we didn't own. Yeah, just a lot of stuff there. This is probably the last super busy one unless I
Anything
guess
catch your eye? Any earnings not in the portfolio that were like, might have to relook at that.
maybe. I mean, I looked at Coupang, that South Korean e-commerce company. Seems solid. Stock's been a bit strange with the reactions on the report. It went up right away and then went down. But so I guess that's not too crazy. But what other companies? Looking at Disney, I guess because we're recording for them next week with Brad. But besides that, just kind of standard earnings reports. So a lot of I don't want to call them all bubble stocks, but a lot of stuff that's been down has shot up quite a bit. Did you see? I never know how to pronounce this company's name. Invite,
Invite?
Envite,
Yeah.
that little short squeeze
Invite.
there. I
I didn't
don't.
see what happened. No.
I think it must have just been earnings, and I don't know what caused it, but I guess short squeeze stock was up like 200 something percent. I don't like to see that just because it seems to me that maybe
The froth isn't. There's a little bit of froth left.
yeah, maybe that's kind of what I think. But and some other stuff as well. I mean, we've seen off of the lows in June, we've seen some stuff up 100% that just got totally bombed out. Let me look up I guess Carvana could be a good one. Let's see. Can you guess how much Carvana is up in the past month? So 30 days. Take a guess.
75%.
As of this writing, 100.2%. So people are working out the intrinsic value of these companies. I think not to
I mean,
that's a
Carvana.
joke, but
I think Carvana raised a whole bunch of money, and that was pretty much the big issue for them. So
what
maybe
years
that's helpful.
are you sure you're talking about this year? I thought that was wouldn't that be every year going back to its entire existence?
I mean, yeah, liquidity has always been sort of, but it's always been more accessible. I think there's some big investment that they did buy themselves some time with the convertible notes or the senior notes. I think it was $3.2 billion worth for the acquisition of that auction company.
Yeah, but that was before it bought. I mean, that was
And then 1.2 billion in equity raise, and then I think they may have done another equity raise recently because I saw something. But their earnings sucked. I read through them; they were pretty bad.
yeah, that's just I mean, we covered them on a not so deep dive. I think that one's still free, or maybe not. Don't quote me, but I just don't know. Like, I kind of I looked at it and I was like, why would I ever follow this again? I don't short, so if you know what I mean. Like, there's just so many issues with that business. I just don't know why I'd take the risk. But hey, some people own it. Maybe they'll do well, and they've done well, quite well over the past month. I mean, 100% returns. It just feels not like no one knows what to do. Like, is sort of my feeling. If you get what I mean, no one knows how to react right now. Does that make sense? When things are just kind of trading sporadically. We had inflation. People are confused on the month over month change versus the year over year change and how those are two separate things. But what do you think on that? I got I got nothing, but
I mean, there was that. Yeah, I think it went viral. The Biden clip of like he was like, we had 0% inflation in the month of July, which
correct. Which is correct technically correct.
I mean, all right, if you're the president or anyone who's like getting blamed for this, you're probably looking at this, frankly, on a month over month basis and trying to keep the cost of goods stable. Not only on by your actions on kind of a daily basis, you probably do. I mean, he's painting it with a rosy brush, the results, but you're managing, you're not managing from last year, you're managing from the position you're currently in. So technically it's the most recent information. I didn't have as much of a problem with it as everyone else, but he kind of made it seem like a brag, which it's nothing to be proud of.
Yeah, it's just 1 month. I don't want, we don't want them to get, especially because it's out of their control. So why do people blame them anyways? But I don't know, it's just 1 month, so you never know what's going to happen. But yeah, I think
I was wrong about that raising money too. I haven't found anything on that.
I think you're just thinking of the one before
there was some article that got released about a Tiger Global partner that left the hedge fund or something like that. That was released in June, but yeah, you know what other one I've been looking at? So I recently had to take that class, which is finishing up now, and Chegg is, I mean, they have really, I feel like, unlimited pricing power. Maybe not unlimited, but if you're a student and the work or the coursework is on Chegg, like, you're going to pay, you're more than willing to pay $15 a month to essentially pass the class.
As we all know, college students have really large dispensable income. So I think that's a little bit of a take, Ryan, but I see they provide a lot of value.
I mean, okay, you're paying $1,500 for a course, let's say. You're not going to pay $30 to pass that course?
Well, majority of people are.
They raised prices $1 and turned in a flinch. I don't see any. People are going to pay that if the answers are there.
Well,
and
$1.
The longer that they exist, the better the catalog becomes, more valuable it becomes to the next incremental user. So
what was their price before? What was the dollar like in percentage terms?
It was $14.95, raised it to $15.95. They were like, all right, well, we wanted to see if we could. And they were like, yeah, nothing happened.
That's not much of a test.
All right. You raise it by, what is that, 7%?
Yeah, that's not, come on.
You're telling me you wouldn't have paid an extra $5?
No, I'm saying
that class.
I'm saying I'm saying that's a big difference between saying they have unlimited pricing power versus them raising it 7% one time.
It's essentially a green check for and it's for all your classes essentially, unless you're in some like super custom STEM where everything changes frequently. If the course material has been used by any professor ever, I mean, Chegg can really, I think they can throw whatever price they want out there and people are going to sign up for it.
Yeah, there's just structural problems with that business that just, I mean, why bother investing? I'm sorry for the fact that they're not playing as they're not playing a, let's see, what's the best way to say it?
Colleges don't like them.
Yeah, I guess that's a good way to put it. What I found is professors would purposely make stuff to be anti-Chegg just so you couldn't, use them. And obviously a lot of professors don't care, but I think that's just a problem. I saw that more and more as I got older. So Chegg got really popular as I was getting into my later years in college. And there's just huge risks with that business. And it makes sense. Like it's one of those, it feels like one of those where I don't know, everything looks good until it doesn't, or there's that risk of just totally um losing the like just losing business because all the teachers or not teachers, professors and colleges kind of get their act together and say, hey, look, everyone's just cheating online through this company. We're going to work to stop it. Maybe they can't stop it,
Yeah,
but
I mean, honestly, what can you do?
you cannot. I don't know. I
You
mean,
can make your questions new, which I guess like if the professors are really into their job, they probably do. But now the Chegg network has gotten good enough where you can post that question. It's not all the old catalog either. You can just post the question and then they've got like Chegg has collected or aggregated enough experts now that that question is going to be answered in less than 30 minutes, most likely.
yeah, I mean, they could just tell you that you can't like have a login. Like the school could ban you from having a login. I think
That's literally how would they do that?
they have all your information.
What do you mean?
Like schools, I mean, schools have a lot of, information. They could say like, I mean, yeah, you could work around it, but I'm just saying there's barriers the schools can put up against this, like against the
They've been
company.
trying to do it for like 5 years and Chegg's grown every year. So I don't see it as a like, yes, universities have tried, but I think eventually you probably like there's nothing they can really do. I mean, I'm witnessing this firsthand right now. And I was looking at the results. They raised prices. The business is humming along fine. They're getting more and more users. Now, granted, there's a pretty
but the bigger they
short
get,
lifespan on those users. You're recycling it pretty much every 4 years. But
well, I mean, there's no new students coming in. I guess they have decent, but the bigger they get, the bigger the risk of revolt gets. Isn't that kind of an issue? Like the larger they
there
get,
is no way to revolt.
I mean, no, there's no way to revolt like with a one move, but there's just it's sort of like it's like something that has bad health effects. The more and more people do it, the bigger the risk of like you can't stop kids from vaping or something like that, but you can set restrictions on.
I would say if that's the comparison, then it's probably a good time to get long Chegg.
Vaping? Oh, come on.
I'm
Jewel?
talking about cigarettes.
No.
If there's bad health effects, I mean, the return on pretty much any cigarette company, I think, has been pretty strong.
Well, I was mainly referring to Jewel, but as the youth part, but I mean, I see what your point is about like they provide a lot of value to this customers, but just within the ecosystem they're in, the industry they're in, there's just permanent risk there that I just don't know why it's investable.
Well, share count is down 15% year over year.
Well, that'll entice me. Not joking.
Yeah.
That is enticing.
They are buying back in spades here. We do have a question. What are your thoughts on high stock-based compensation in tech companies? Every deal I get excited by just gets smashed because of high SBC. The problem is that I don't ever see this going away. Yeah, it's a worthy concern. I think it's just a matter of, well, for one, pure SBC, the SBC line item taken on its own isn't hugely valuable. You kind of have to look at just shares outstanding over time and see, and then check what their granting pace is going to be. Brett's can probably explain better how to do that. And it's all in, I think, either the proxy or the 10K, and probably all the Qs as well. But there is something to be said for the stage of the company paying in stock and giving some incentive, but it's you're taking the risk of tying potentially employee morale and performance to the stock if you give them too much. So I think, yeah, examples like Coinbase, which I think was at like 31% or something like that, Palantir, which is at 39%. Unless you have a top tier manager who's very good at managing expectations, there's probably going to be employee attrition when things go poorly, like we're seeing at a lot of tech companies. Although right now it seems more that the companies themselves are firing. I tend to try to avoid companies that issue a ton of stock.
What? No,
Especially
dude, look at our portfolio. Come on.
If
That's a lie. That's a lie.
30%, north of 30% of revenue.
Sure,
You're
sure.
telling me
Okay,
you
well,
do that?
that's fair. I mean, that's rare. 30% of revenue is rare, but we have tons of companies that issue stock consistently in poor form, I would argue. But I mean, it doesn't make something, I don't think it makes something uninvestable unless, yes, it is egregious in that super high double-digit range.
Well,
But
and it's just we own companies that do issue a lot of stock, and there has been dilution over the years. However, that's just how we look at it. We look at it as how have the fundamentals grown on a per share basis? What, because revenue growth plainly can be not great if the revenue per share over time, and same obviously as you go down the income statement into the cash flow. But I think there's some examples where it can help a business, and there's some examples where it's masking real problems. Jumia is one that I don't think revenue has grown over the last 2 years on a per share basis, but reported revenue is up almost like double. So, or gross profit or something like that. I remember looking at that one. So I don't know. I just look at the performance on a per share basis. What are your thoughts?
yeah, just if you're gonna like say every idea, like here's the quote from the question. Every idea I get excited by just gets smashed because of high SBC. That feels like a flawed strategy to me, to be frank. You have to just take it into account, because if you're gonna exclude all these companies, that's just excluding a lot of great companies. I mean, look at Google's share count from, let me just pull it up. Oh gosh, hopefully it goes all the way back. Their share count was growing until basically 3 to 4 years ago. I don't have the exact timing on here. Yeah, okay, if we go from 2006, their share count was, okay, like 11 billion, and then it inched up to, say, 2018 timeframe, 13.7, I think, billion, split adjusted. Either way, steadily went higher, tons and ton of SBC. Still a great business to own. Now they're returning stock. Now they're returning capital to shareholders and reducing their share count pretty consistently, which is another plus. But it's just a factor that you have to consider. And yeah, there's that risk with employee attrition. So if too much of their compensation is in stock, it's just something to track. And that does add as something as a risk. But I wouldn't say it's like a red flag unless it's, again, like Ryan talked about, 30% of revenue, like some of these companies. But that's few and far between.
And if it's, I don't know, because sometimes I see people say, all right, they generated $100 million in cash, but they had 50 million in stock-based compensation. So they're not really generating any cash, kind of thing. But I mean, they're generating 50 million in that case, but whatever. I think that's maybe too simplistic of a way to look at it, because if that cash is growing on a per share basis or your claim on it, it doesn't really matter that they're drawing that back. But at the same time, those companies that are allocating 30% of their revenue to stock-based compensation, I have a hard time believing they're going to grow cash flow on a per share basis.
They better
it's just
uh,
unrealistic unless they grow revenue really quickly.
Yeah, they better have 50% quote unquote free cash flow margins. If they do. But yeah, I mean, this all comes down to free cash flow per share. Yeah, if there's SBC, there's going to be a headwind on free cash flow per share growth. But as long as, I mean, if a company is, okay, if someone's, say SBC is 5% of revenue, and yet free cash flow per share is consistently grown at a 10 to 15% clip, in my mind, those, like, that's not uninvestable. I mean, it depends what price you're paying for something, obviously, but just because SBC is heavy, I don't think necessarily makes it uninvestable. This segues into another topic that I saw this week, and that is or yeah, one more thing. Okay, go ahead.
The other thing is, if you're running, let's say, one of these businesses where developer and engineer talent is it's in high demand, and you're a relatively young business, the stock-based compensation package, I know Brett might be wincing at this, is probably a good tool if it's used properly to attract talent, and if it's employees that actually buy in. So even though you could just pay them really, really well in cash, I imagine some employees like to have ownership and feel like they're a part of something, almost like a team, because they pretty much are on that team. So I think managers do use it as sort of an incentive tool.
Yeah, that's fair. I wouldn't argue with that. However, if you have like, if you're a company and you can't, like, you don't have the cash to pay people, sorry, you don't have the capacity to pay people in cash, you're forced to pay in stock, I think you should first reevaluate your business model and expense structure, because maybe it's not viable. But besides that, yeah, I get it. But that leads into the excise tax on share repurchases that has been proposed. I at first thought this was a bad idea, and then I read more of the details and I found out it's even a worse idea than initially proposed. Yeah, it's only going to be 1% on share repurchases, and it's for companies at the company level. But here's some little detail that just, again, it's only 1%, so it's not going to be a huge deal, but I just think totally misaligns companies' incentives for creating shareholder value. Here's a quote from the Wall Street Journal. I know the legislation can change, so if you're actually, care about this, read the actual stuff that could be changing as it goes through, all the process. But here's the quote: "The tax on net buybacks total shares repurchased offset by the number of shares issued during the year. For example, as a part of a stock-based compensation program or because employees exercise stock options." So they are only going to punish companies that reduce share count, which,
Oh, that's terrible.
yeah, it's just, I mean, it's 1%, so it's not a big deal, but that just feels,
Oh
it's
my
going to
God.
incentivize more SBC and disincentivize reducing share count. I mean, maybe that's good for society because more people will become owners, or if you get what I mean. But from a shareholder perspective, I don't. That doesn't seem great.
No. So it's net too. Essentially, it's net shares repurchased that
Yeah.
are going to be taxed.
Oh yeah.
Oh God. I don't know. Yeah. I don't know what to think, because 1% doesn't sound like a lot, but
Yeah,
it's after tax money.
I know it's weird. Well,
Isn't it
yeah,
essentially? I mean, they're paying that basically out of their retained earnings or cash that they've generated in the past, assuming that they've been taxed on that cash that they generated.
yeah, it is a double tax. Should they just tax net income more? I don't know. I think maybe it's this, again, I don't like the idea of taxing share buybacks, just, and the same as dividends, but the positive spin could be that net income isn't perfect and people can massage that to make it seem like they're not as profitable as they truly are. So taxing buybacks and dividends, well, at first principles might not make sense, it would actually be taxing the capital returns back to the shareholder class, which would maybe be a better metric on the true profitability of a business, because if they're trying to return cash to shareholders, they have that capacity, they've been generating excess cash. Now, there could be some flaws in that thinking because I'm just kind of going up, making this up on the fly, but I don't think it's a terribly negative thing. But as from a shareholder point of view, I'm not the biggest fan.
No. Would you rather have that or have your income tax raised by 1%, let's say?
Oh, I don't know. They're both not, until it gets to like 10%, it's kind of not noticeable. So don't really have a take. But if it was at 10%, yeah, the buybacks for sure. Like, companies can work around that better than I can work around sales tax.
Yeah. Any other big notes from the week?
Oof. Um, what
I saw that
happened
our friend Francisco Oliveira was mentioned in the Wall Street Journal
on the
on this morning on Disney's earnings report.
Yes, when we were
Congrats.
when we record, yeah, listen to his show on Formula One. When we record Disney, that's the person in the back of my mind. Like, all right, I got to make sure when we record this episode on Disney, I get things right because I like think of like, okay, if I was talking to him, you know what I mean? Because he knows that company so well.
Yeah.
Our friend listener, I'm thinking, I'm guessing one of the 5 watchers on YouTube. Um, the Elon Musk decided to sell some more Tesla, even though he said he wasn't a few days prior. Are you surprised? Or are you?
Shocked.
Yeah.
That's shocking. Never saw that come in. And you know what is just a load of crap? Oh no, I'll buy it back if I don't have to buy Twitter. Like,
I
shut up. No, you won't.
I made sure to screenshot it.
He'll buy like a tiny portion and then see, like, so I say, told you.
Yeah, he's gonna buy back all 20 billion or whatever it is. I don't know the exact amount. But it is kind of strange. He like was hyping up the stock at the meeting and then selling it. They
Well,
had the shareholder meeting.
what's he
Isn't
gonna
that
do? What's he gonna do? Talk it down and sell it at a lower price? No.
who would do that? Warren Buffett. Um, or actually, speaking of, we just had that show on Winmark come out today with Jim Gillies, and maybe the biggest highlight I had from that was the chairman or CEO, I forget who, deliberately selling at a discount to the traded price as the company buys back stock, as he kind of leaves the company and is retiring. I thought that was a huge, like seeing something like that when looking at a potential investment is just huge for evaluating culture and management. But back on Elon, yeah, that I mean, okay, here isn't that what someone at Enron got in trouble for? Is saying like buy the stock or like whatever, like shorts are screwed, however they said it, and then selling stock like in a form for super close after. Is Elon just above the law? Are we just realizing that again?
Oh, yeah. I mean, come on. This is known. It's so,
Um,
I don't know. It blows my mind that don't shareholders don't care.
oh, you
Like,
gotta
it's
let.
happened how many times? He's sold what, 35 billion worth of his shares, and
Uh,
every single time they say, like, well, he needs it for like the good of humanity for some bullshit reason. Like, dude, just look at what, come on, he's selling.
I know the spin zone on that is astounding. Um, yeah,
The
you got something? You got a
Yeah,
topic?
there was a acquisition recently that was blocked, a Facebook acquisition,
Oh,
and it made me think. And it was basically they Meta was trying to buy this company called Within that has like a boxing subscription service that's like VR subscription based boxing, and it's got like flow class. It's like a fitness classes, um, and the FTC was like, basically, no, you already have something like this. It's anti-competitive. Plus, you could just build it if you wanted to,
yeah,
which makes me think that if acquisitions were hoping to be a part of Meta's strategy, that's not going to happen.
yeah. I think they just got to play with the cards that they're dealt. It's interesting that Amazon and Microsoft just seem to be going willy nilly. It doesn't seem fair to me,
Oh,
but
that reminds me. I saw someone say that the purchase of iRobot, Amazon's $1.7 billion purchase of iRobot, is the most dangerous acquisition in company history.
oh yeah, it's going to
What
be.
what could Amazon possibly do with iRobot's data? Honestly, how does that even help them?
They're gonna
They know
sell
like
more.
the size of your living room rug.
Hey, you're Mr. Defend Alexa about the data advantage. So you explain. Uh,
But Alexa, is interactive. This is just what can they do with a map of your
Robot.
floor plan? Honestly, there's
R-
nothing that. How does that provide any benefit to Amazon? I think Amazon might have done it just to test the regulatory waters. Be like, all right, what's the most pointless thing we can buy? Let's see what regulators think of this. And they're
Hey,
like, oh, let's buy vacuums. Like, obviously, no one's going to complain about vacuums.
hey, robot vacuums are interactive. I don't know what you're talking about. They're interactive. They collect data.
You can't, okay. You can't make a purchase order. Maybe you can. Maybe Amazon's going to change it. But who gives a shit if you order something from your vacuum? Like, I don't know. It doesn't provide that much. It's just
I
the
know
hardware.
that.
I honestly now, at
No,
first
they
I was
have
like,
they have
Alexa,
this
whatever.
they have the scanning thing. They have the scanning stuff. So like it maps your home and stuff like that. So the theory this guy had was that it would basically be super anti-competitive because they'll know what you need at your house. But I mean, great if they can actually
Yeah.
if they could actually figure that out.
Isn't that great for the consumer?
Yeah, that I would enjoy that. But all the smart devices just like they just annoy me whenever I get any sort of appliance that's internet connected, which I know Amazon's going heavily into. It just they always don't work as well. Like my family has a 30-year-old toaster that works beautifully, way better than any other smart appliance they've ever gotten. And it's, can I just have that again if anything
There's
ever breaks?
no, I don't get that. There's zero way that the vacuum's going to be able to be like, oh, he needs new oats.
It's just the scanning of the maps of the homes. So I think people are just worried about that data. But
All
again,
it's got
like,
is your floor plan. I mean, it's
yeah, the people have, I mean, that is, don't real estate companies have it? Yeah. All right. But back to the Facebook stuff. Yeah, that's kind of, I don't know why they're blocking that acquisition. Maybe they just don't like Meta slash Facebook, but it seems that that's their strategy because Microsoft and Amazon have been going not crazy, but pretty consistently buying companies that you would argue have the same sort of scale benefits. Obviously, they're all different. Maybe Meta, that's just the cards they're dealt. I don't know. I don't really have anything else to say about
I
that.
would say maybe it's a little self-earned.
Well, yeah, that is true. That's fair.
Judging by some historical events.
Historic,
But
some historical things that they may have either done or like not looked into with enough care as a $100 billion whatever company. Here's something that maybe that I was kind of poking around my head that could just be a terrible idea. Like people just don't want companies that are big enough size to be able to buy up all their companies, right? This has always been a problem, right?
it makes sense
What if like if you're mm,
if it
maybe
only
it's
benefits the consumer.
no, because that's a little hard to say. What if your company that is say as a percentage of GDP, say either probably not your revenue, it would have to be market cap as a percentage of GDP is at a certain threshold, you're not allowed to acquire companies anymore because you're too big.
I mean, maybe,
You're
but
you're so successful that for the time being, the society's like, all right,
I
you
think
want
maybe there's a better barometer than market cap because we've seen some companies, some trees grow to the sky, even though maybe it isn't earned.
so Tesla's too
Yeah,
anti-competitive. Maybe maybe that's not the perfect.
I want to be too upset if Tesla started making acquisitions.
Yeah. All right. Here's a good comment from Matt. I think it's the same Matt H. Thank you for joining all the time. Meta spent $20 million on lobbying in 2021. They need to up that spend.
Yeah, they
Most
need to
likely.
bring in Altria's lawyers.
Yeah. I mean, the tobacco lawyers are top notch. They're always getting that legislation that makes no sense for anyone except tobacco companies.
The
Shocking.
thing is, they probably could pick the next president if they wanted to. So I would
Stop.
think people would be more. You don't think that
Oh, Meta.
and
I thought you said,
Twitter?
I thought you meant the tobacco companies. I was like, but
No, no,
Meta,
no.
sure. Yeah. If they really wanted to get like mean and really like flex push the button or push the pedal on
The political
with their,
power, yeah, they
yeah.
could.
I like how much the crypto industry is lobbying You know how there's just a ton. It's a ton. And it's not
Save
surprising.
us.
Yeah.
What's with the like? You need to cover our losses. We should be FDIC insured. Screw the big banks, but we'll take the bailout.
Yeah, we're gonna disrupt the government and national currencies, but actually no, we need to
Screw the
partner with
Fed.
legislators and we need FDIC insurance. It's very ironic, as maybe Senator Palpatine would say. All right, here's a question from, and I've been thinking about this because we've kind of been covering streaming, researching it this week for our not so deep dive. Here's a poll from the Science of Hitting, Alex Morris. Netflix will launch a free ad-supported tier by year-end 2024. 56% of people said yes, 43% people said no, or 44% of people said no. So basically a tie. What are your thoughts on this? Is there enough inventory? Is there enough inventory to make a free tier successful for some of these streaming companies? At least the larger ones.
Free. I don't think they've expressed anything about free management.
They didn't express anything about advertising at all a year ago.
Yeah, but I'm saying like even when they talked about it, they mentioned that it was like, I guess they didn't say anything on pricing, but like Paramount Plus does, I think it's $5.99 ad supported, $9.99 without. I think they're probably going to say like, I mean, they can probably do the math and say at what price does average revenue per user from the ad supported side get high enough to make the cost worth it or cash flow positive generally.
Yeah.
Maybe they sell it as a loss later at the start, like free, and then up it, but that seems like a bad strategy on the ad supported side. The other thing is I hate ad supported plans they have to pay for.
Yeah. It's a double
better
pay.
To go free, but
unless it's sports,
that would have to be ads everywhere.
Yeah, unless it's sports.
But I mean, that's what YouTube. It's basically YouTube.
Well, you mean with
it started free, you know?
You mean with ads everywhere?
Yeah.
Because isn't it 2 tiers? If you go premium, there's no ads, right? Or am I don't know. I don't have premium.
No, that's right. That's what I'm saying. Is like if you just make the free experience so absolutely horrible. All right, see, this bothers me. Apple gets to send just like notifications to me instantly. I have to allow other companies to do it on my Mac, but Apple gets to do it immediately. That's BS.
Join Team Android. Come on, make the switch. Join the dark side. They're never gonna do it. Everyone, you have to buy. Sorry, we'll go back onto what you're talking about with the streaming, but yeah, everyone has to buy an iPhone to differentiate themselves, even though everyone 100%. Owns it. Yeah, you got to be different.
It's the only way to be unique.
You got to prove you're superior by owning what everyone else owns. All right, but back to ad supported.
Oh, I forgot where I was, but
comparing to YouTube, the two separate.
Yeah, I mean, you just make the ad supported experience so absolutely horrible and bog it down with ads until people, decide, all right, I guess I'll up to premium. Although YouTube's more unique, in my opinion, than like if Netflix bogged it down hard with ads, I think there's too many alternatives.
Yeah, I think the problem isn't even gonna, again, I'm not versed on the advertising industry or the advertising technology industry, but we have all these companies coming into streaming, trying to do connected TV advertising essentially, right? I feel like the issue might be that there's just not the advertiser supply yet. So I don't know if that, you know what I mean? There's going to be so much inventory opening up. I wonder if the problem won't be that there's too many ads, is that they got to fill all these different slots and it's going to be a build up slowly over time.
Yeah. I think and they're doing it at a point when there's sort of an advertising pullback. We do have a comment that says, not sure if you spoke about Disney, but they're torching cash on streaming also. That doesn't surprise me. Although
we'll cover it on the not so deep dive this week, I'm sure.
Yeah. I was going to say, in some of their offerings, they are seriously underpricing.
Not anymore. they're raising. Disney
Yeah,
Plus is $10 now.
I'd say it's still maybe not on the Disney Plus, but if you get me with live sports like ESPN Plus, I'd probably pay $20 a month.
Yeah, it's only 10 right now. Plus, I think that's the underrated thing about the sports, which I've harped on again and again, is the fact that people will pay and there's distinct times for advertising. So you get that great, I think you get phenomenal ARPUs. Which they actually mentioned in their conference call that ESPN Plus raised to $10 a month from like 6, which is a pretty steep bump. And they don't even have nearly all of their content on there from a sports wise yet. At least none of their flagship stuff is exclusively on ESPN Plus, and nobody churned. So, or not nobody, but they saw no change in a churn dynamic. So that's a pretty positive sign.
Yeah. The other thing, kind of to touch on Matt's point, I just don't know if I'm going to touch anything streaming related
Until someone can
Like
prove
right
they can
now?
generate cash. Yeah.
Yeah. I mean, everyone's in this like horrible competitive environment to see who can produce the best content. And it's just like, yeah, everyone's going to acquire more users, but this like aggregate cost to acquire them is just elevating.
It's interesting for sure.
You know what else I saw? I saw that the Roku channel allows, so you can like sign up for, I think it's like 50 different services. Paramount Plus is included in the Roku channel, and then you can like navigate Paramount Plus within the Roku channel. What's the benefit for Roku to do that?
I think just better revenue share, probably.
Just like a higher likelihood of
Yeah.
transactions.
A higher, I don't know what yeah, that doesn't really make sense. The Roku channel strategy doesn't make sense.
I don't think they've expressed a strategy at all or laid out anything that they want to do. I don't get
Yeah.
it, but
Yeah. All right. Here's another one. Avalera, Seattle native, Seattle prospect, got bought out at a pretty decent discount to their all-time high. Is there any way to like, how am I trying to say this? Is there any way to be proactive in finding companies that will not, take themselves out, get taken out during a downturn, and you maybe get a 20% loss if you're buying for the long term? Do you just have to make sure you buy at the right price, or is there something with management that can come into play?
I don't know. I mean, even if you have a whole bunch of insider ownership, people might just want out. Like,
Yeah,
they might just have their own personal situation where they want the money now.
sucks. Can't really
You
control
gotta
that.
find someone who like really loves the business. Like they really like their job and you can tell, but it's hard. Like even you can every CEO is going to masquerade that, but you think like,
So Mark Zuckerberg, you're saying we should buy Meta? No, I'm joking.
I think Zuckerberg would fit into that category. I mean, Warren, obviously, because he's outright said it like 20, probably a million times that he loves his job.
No, if he makes it to 100, I'll say he's dedicated. If he's if he's CEO at 100, then maybe we'll talk.
I think maybe Reed Hastings fits that bill.
Sort of, but he kind of was when they were like cruising along. He was kind of saying I was, I mean, he was giving more
It's now
stuff.
co-CEO.
Yeah, exactly. That co-CEO thing with Sarandos. Although I bet he's back in now. Kind of. What you mean? What am I trying to say?
A little more
Like,
hands-on.
yeah, hands-on, exactly.
I don't know if
Yeah.
there's a good way to tell whether or not management will take the payday.
Yeah. Who can blame him? Someone gives you a good buyout opportunity. But with the Avalera one, there wasn't much of a premium, which is probably disappointing for shareholders. But
I mean, companies buying back a ton is probably a good indicator.
Wait,
Because
Swedish match.
I suppose, but I would have thought like, hey, if you're buying back, you're not going to sell unless it's a pretty steep premium because you think all right, we're already trading at a discount. And it may be like companies that are buying back opportunistically, not just putting it on the back burner, like, and they've done so recently or at around the price, because then you can say, all right, they've made it clear they think this is a discount. There's no way they're gonna sell for anything less than this.
Well, they're just buying back because of the tax incentives with stock-based compensation.
Yeah, get them all out before the end of the year.
All right, here's a question from, sorry, don't know how to say your name. Thoughts on Apple and Microsoft making up over 13% of the S&P weighting?
No way. Do they really?
I'm going to say that is correct. Yeah.
Damn. I would say at that point, yeah, you stop letting companies acquire other companies.
As the percentage, yeah, Apple's really run up since they had that solid earnings report that we talked about last week. Gosh. I think there's a lot of avenues to go when a company, like there's a lot of different things that can happen when a company makes up such a large portion of the index, especially when index funds are so big with so much flows going into there. I'm a little over my head discussing that, but just there's a lot of flows that are probably going into Microsoft and Apple stock. When consider, it's tough.
It's like buy Xbox on its own.
Yeah, their strategy has been sound the last few years. They're definitely doing well versus Sony, although that's a just classic duopoly that, oh my god, what a take rate on all those games.
Hey, Switch,
yeah, but that's their own. I mean, they're their own
People
beast.
don't play COD on the Switch.
Yeah, you can play maybe COD from 2004.
Yeah.
But that, yeah, as the company's making up that big of a portion of the index from an investing perspective, maybe, well, I guess if you're buying the S&P 500 index fund, you're betting on a lot of fan mag earnings growth. And feels safe, feels fine, but I don't think there's any huge, like, you can kind of turn your head into a pretzel of thinking about all the different.
Here's the thing. Do you think in both cases, do you think they extract more value than or do you think they create more value than they extract? Because I would say as long as they're creating more value than they extract to society, don't do anything.
Microsoft, 100% is creating more value than they're taking. Apple, I would say probably no. Because like if Apple went away, people wouldn't, nothing would tragically go wrong, if you kind of get what I mean. Like people would be a little bit annoyed. They'd have to get a different phone, Android, whatever. But it's not like their life's over. That people might say, my life's over, I don't have an Apple phone anymore. But if you kind of get what I mean there.
I mean, I would say Microsoft's probably the same way though.
Oh, if Microsoft, no, dude, if Microsoft went away, the world would
hop to a different email, hop to Google Sheets.
Okay, dude, no, the world would collapse if Microsoft went
How
away.
so?
Everything is, you know, that meme of
everything has to go.
Everything
convert it to Google Sheets.
Dude, that takes.
I know the world runs on Excel, but
whatever that meme is with the guy with but you can't. That there's so much switching costs there. It would take decades.
Think about all the data that's stored with Apple. I mean, it's like the same as everything that's stored with Excel.
In a way, yes, but also in a way, no, because it like Microsoft is kind of the grease that keeps the world running, the business world running, I should say. And Apple's just a good brand. Yeah, see, I'm a Google Sheets. I love Google Sheets, and no one uses it, but no one uses it but us. People laugh.
Yeah, someone said Google Sheets with a laughy face.
I love Google Sheets.
Take offense to that.
I love Google Sheets. Google Finance
API.
Google Finance API is great. Updates constantly for us, but it just there's so much built into Excel, just in the global economy. That
how much of the global economy is built into Excel? Is that you mean?
Yeah,
it's true.
But I mean, yeah, I just think,
Another guy said Google Sheets with I think a puking emoji. All right.
hey,
I guess hey,
Excel's got,
we have a shared folder. Okay. What am I going to do? Convert Microsoft Excel every single time? It's a waste of time.
we're broke. We also just have free Google Drive, but that just shows you how little money we actually make. But
Yeah,
what I was gonna say is Excel is a great brand. People love it, especially in finance.
it's true. You know, at one point I was listening to this business breakdowns episode on Union Pacific. I think in the I think it was the early 1900s, the railroads made up 60% of the Dow, the 30 companies in the Dow, the railroad-based companies.
The early 1900s, you mean?
Yeah, whenever the Dow was like
Invented.
first.
That'd have been
Yeah.
late 1800s, I think, or maybe early 1900s, super early 1900s. Yeah.
Talk about a monopoly, oligopoly, whatever you want to call it. I mean, it's hard to build railroads these days because of all the regulatory stuff. So, you know, those they just have like a permanent advantage as long as the government doesn't opts not to build them themselves.
Yeah. You can't, the digital revolution is not going to be able to enable you to break the laws of thermodynamics or whatever you want to say, the laws of physics. Yeah. But the fact that the railroads is such a large part of the index is kind of a good pitch for index funds, because if you just own index funds, you basically ride all the technological change and the companies that are becoming the larger part of the index and then falling and stuff like that.
Whatever becomes a more valuable part of the economy, you're going to own.
Yep. Let's see. Anything else? Anything else
in a
this week?
tax advantaged way as well.
That is true. That is true.
Sell.
They sell for you. What did you think of the AMC ape stuff? I didn't look into any of the details because it looks super complicated, but
neither did I. But you know what? Kudos to that CEO, man, for
oh,
just selling his
come
soul.
on.
Just sold his soul. I honestly respect it.
Yeah. Thank you for being facetious, but
no, I mean, think, you know, I think you would have done the same if you knew that you'd get what's his, I assume his payday's been north of $100 million.
I hope I would not be doing the same thing in the same manner. I hope I wouldn't.
Well, he's playing to his audience, man.
Yeah.
Maybe he just has this pet thesis that it's going to somehow increase ticket sales.
There's so many of them that they're gonna go to so many other movies, but that's just bullish for Disney because Disney gouges them on ticket prices. So it's not like they actually. Whatever.
What's the last movie you went to in the theaters?
Top Gun.
Damn, I never went to that in theaters.
You should go before. Yeah, I think so. You should go before it ends. It's probably only good in theaters, really.
I've been to a lot of those Disney ones lately.
Oh my god,
quite underwhelming. I will use that in anecdotal evidence when we record our episode tomorrow.
I'm looking forward to She-Hulk Attorney at Law to be. No,
I thought that wasn't canceled, was it? Which one was the one that got canceled by the company?
That was Batgirl. But you went to see Thor, whatever. Yeah, instead of Top Gun. Come on, that's just your own fault. All right, so we had nothing on AMC.
No, literally nothing. I just don't keep up with it. And there's always so much going on that it's so hard to keep up with.
Yeah.
AppLovin is buying Unity. Did you look into that at all? Which
really
kind of a fish that ate the whale situation there, if I'm not mistaken. I think Unity was larger than AppLovin.
I was gonna say AppLovin's that big of a business. 13 billion. Okay. To be frank, I've never known what AppLovin actually does.
Let me pull it up right now.
Let me see the description. AppLovin engages in building a software-based platform for mobile app developers to enhance the marketing and monetization of their apps in the United States and internationally.
It's Unity. It's literally Unity.
Yeah, you could not tell me the difference between both of those. Well, hope it goes well for their
50% premium to Unity's share price. Wow.
Good for Unity, whatever, people that bought the dip.
All right, hold on. I've thought about this. 50% premium to Unity's share price on July 12th. Nearly 20% premium to yesterday's as of this, whatever, when this was written. Either maybe that was the market overall just rising. But every time I see that, I think, God, I hope the SEC is looking into that. Whenever you see like this weird, random, just like gradual increase right into an acquisition price, like, come
Yeah.
on.
Yeah.
Someone knew. And someone was buying.
Someone's leaking. Yeah. And then we got a comment. Didn't Unity buy Iron Source? Yeah. I mean,
Oh, I saw that it is the AppLovin deal is contingent on them not buying Iron Source.
oh,
So it's kind of an own to management, Unity's management. If AppLovin's saying we're only going to buy if you scratch the Iron Source deal.
yeah. I don't have any. I don't know
No,
anything
it's
about any of the
honestly,
companies.
I think a lot of people buy developer based companies that are built for developers without understanding the competitive landscape involved there. Because I don't know, everyone loves Unity, but I've got a feeling that Unity is not the only one doing what they're doing. And obviously they aren't.
And also, we don't know. And we would have no idea if there was a startup coming along that it kind of plays into the fact that you want to counterintuitively, people might disagree with this, invest in industries that have less technological disruption.
Yeah.
All right, I want to do a good game here. I'm going to lay out, okay, the years don't matter. I'm going to lay out revenue growth rates for I think it's a 7-year period. Yeah, 7-year period for a software company. And I want you to tell me whether you'd buy it or whether you'd be interested at all in this company. Okay. First year, 3%. Second year, 16%. Third year, -2%. Fourth year, 13%. Fifth year, 25%. Third year, -3%. Fourth year, -5%. If you saw this tweet from someone, you might be.
I didn't see it.
Okay, good. Would this keep you away? Like, would you be like super, I don't know, worried about this company in general? Like after you take kind of a first glance, you'd be like, okay, what's going on? Why aren't they growing revenue? I don't know. Would
Yeah.
that just be on its face? What if I told you that was Adobe in 2003 and it 33x? It's just, that was a good little tease from MBI.
Adobe's a hell of a business now too.
So it's hard. Those transition periods or turnarounds or I guess transition periods of business models and stuff like that. It's so hard to predict.
Adobe was also like a fraction of the products in 2003 that it is today. Like I'm pretty sure that was like built on just a few products.
Yes, but that hindsight is, we have perfect hindsight, but at that time, wouldn't it be really hard to look at something like,
yeah,
just kind of shows how hard it is to look at something without kind of, I don't know. I guess it comes down to trusting management strategy and stuff like that. But
I think there's probably a lot of companies that have been in situations like that that haven't turned out like Adobe.
Yeah.
A lot of software businesses, especially around 2003.
Yeah, true. That timing could be strange for the tech bubble bursting. But if you look at, it kind of goes back, if you want those kind of potential 100-bagger stocks, you have to really be at a starting point most of the time where things don't look perfect. Because if things look like if the company's firing on all cylinders, it's going to have a premium valuation as Adobe has today, or at least did, I think. Probably does.
I think the valuations come down a bit if I remember correctly, but yeah.
I mean, if it's above 20, I mean, it's still, technically premium.
But
yeah, it's like 30 times EBITDA if I'm looking correctly. That could be wrong. If I'm not calculating
yeah, you kind of have to buy. I think there's this like a disillusion or illusion, maybe it's just illusion, that companies will get completely disconnected from their fundamentals and you can easily buy them. When companies really drop in price, it's usually fundamentals driven.
Yeah, or something's going on that people are concerned about.
So yeah, I have to imagine most 100-baggers, maybe not like Monster, were bought either at a precarious time or the outlook just wasn't good.
Yeah. I think the easiest one to kind of go into is when revenue is going to be slow for like 2 quarters and it's just some anomalous thing. That's my favorite one because so many people are just like, oh my God, revenue is going to grow. Revenue is going to slow for 2 quarters. What are we going to do? Like they lose their minds. But if if you're pretty confident that that's just going to be a short-term blip for whatever reason, that can be nice. That can be a nice opportunity from my point of view.
All right. It's 101 on the West Coast here. So it's been an hour. Gonna go ahead and sign off. Matt, thanks for all the comments. Ethan or Athan, if I'm saying that right, thanks for the comments as well. Everyone that was on here, appreciate the questions. That's gonna do it. We do this every Thursday, 12 o'clock Pacific time, 3 o'clock Eastern time. Feel free to go to our YouTube, just look up Chit Chat Money. We'll have a live video going and you can put some questions in the chat if it interests you. Thank you all for listening. I guess we should hit a disclosure. Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. Thank you all for listening. Thanks, Matt, for telling us a good show. Appreciate it. And have a good one. See you guys next time.